Welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. Today, we're unpacking a seriously fascinating accounting dilemma. This exact issue was recently featured in the 233rd edition of the Task Weekly newsletter, which is authored by CA Manish C. Iyer, director at Gap Advisors. We're going to be looking at common control demergers, but specifically from the transferor's perspective. It's kind of tricky territory, but don't worry, we're going to make it crystal clear. Okay, before we jump in and start diagnosing our case study, let's just lay down some quick clinical baselines. First up, the views expressed in this explainer are the personal views of the author, and of course they aren't binding. We really encourage you to seek the help of an expert before taking or refraining from any action based on what we discussed today. Also, for our scenario, just assume the functional and presentation currency is the Indian rupee, and our reporting period strictly runs from the 1st of April to the 31st of March. So here's our agenda for today. We're going to start by diagnosing the demerger dilemma. Then we'll look at the acquirer's perspective, apply Ind AS 105, map out the actual accounting timeline, and finally wrap things up with a Gap Advisors deep dive. Let's get right into Section 1, the demerger dilemma. It's time to diagnose the case of Cully Ltd. Meet the cast of characters for our transaction. Right at the top, we've got A Limited, an overseas entity acting as the ultimate holding company. Beneath them is our patient for today, C Limited. Now, they've been Ind AS compliant for 3 years, and they're acting as our transferor, or the selling company. Finally, we have E Limited. They're a newly incorporated company as of April 1st, 2018. They are non-Ind AS compliant, and they're sitting in the seat of the transferee, the acquiring company. The entire dilemma really centers around this specific timeline. During the 2018-2019 financial year, C Limited filed a court scheme, this was in May of 2018, to execute a demerger of one of its business units. We'll just call that unit C1, and it's being demerged into E Limited. The appointed date for this scheme was set for October 1st, 2018, and it officially became effective on January 1st, 2019, when it was filed with the ROC. Which brings us to the big question. If we're sitting in the seat of the auditors for C Limited, is this specific demerger transaction considered a business combination of entities under common control as per Ind AS 103? All right, moving to Section 2, the acquirer's perspective. Let's check the lab results from Ind AS 103. When we dig into Appendix C and Appendix A of Ind AS 103, a common control business combination basically means a transaction involving entities ultimately controlled by the same party, where an acquirer obtains control of one or more businesses. To even trigger the standard, meeting the definition of a business combination is absolutely non-negotiable. Now, here is the absolute game changer, and honestly the blind spot a lot of professionals hit. The very objective of Ind AS 103 is to establish principles for how the acquirer recognizes and measures assets, liabilities, and goodwill. Put simply, the standard on business combinations is written strictly from the perspective of the one buying, not the one selling. So what does that mean for us? Well, E Limited, as the transferee, is the one acting as the acquirer, obtaining control. So they absolutely apply Ind AS 103. But our focus today is C Limited. As the transferor, they're the seller, giving up control. Because they aren't acquiring anything, they do not apply Ind AS 103. Even though this is a transaction under common control, for C Limited, it's purely a sale, not a combination.
Right, Section 3, applying Ind AS 105. Let's figure out the treatment plan.
Since Ind AS 103 is totally out the window, C Limited, acting strictly as the seller, has to pivot. They must instead follow the requirements of Ind AS 105, non-current assets held for sale and discontinued operations. Recognizing this shift completely changes how we approach their books. Let's move to Section 4, the accounting timeline. It's time to execute this prescription. Here is our high-level roadmap. On the October 1st appointed date, C Limit needs to classify the C1 division as held for sale. Then, on the January 1st effective date, they'll derecognize C1 entirely and hit the P&L with the impact. And crucially, this is important, for the previous financial year of 2017 to 2018, the company must not restate comparative information. Let's zoom in on those two key dates. On our first action date, October 1st, 2018, we're assuming the specific conditions for classification under Ind AS 105 are formally met. At that exact moment, C Limited has to measure the C1 assets and liabilities at the lower of their carrying amount or their fair value less cost to sell. You're essentially freezing the valuation of the division based on this strict comparative rule. Then, fast forward to the second action date, January 1st, 2019. The transaction is officially effective. C Limited applies standard derecognition requirements to physically wipe C1's assets and liabilities from their books. The resulting gain or loss from the transaction is recognized directly in the statement of profit and loss for that 2018-19 period. It's clean, it's compliant, and it completely avoids unnecessarily touching the prior year's data. Let's head into our final section, Section 5, the GAAP Advisors Deep Dive. Time to expand that knowledge. You know, the incredibly helpful issue and detailed response we just walked through is actually pulled straight from the massive issue repository over at gapadvisors.com. This site is unbelievable. It hosts over 4,500 real-world issues and responses regarding Indian accounting standards and Indian GAAP. Anyone can register for completely free, submit their own specific issues, and get detailed responses delivered directly to their email inbox. It is literally an essential tool for auditors who need to properly document how they addressed any issue relating to the application of Ind AS. Also, if you want to stay consistently ahead of the curve, I highly encourage you to head over to LinkedIn and subscribe to the Task Weekly newsletter. It's authored by CA Manish C. Iyer, director at GAAP Advisors, and it's totally free for anyone registered on LinkedIn. With over 230 editions published so far, including the 233rd edition that inspired today's lesson, it is a weekly dose of accounting brilliance you definitely don't want to miss. Well, that wraps us up. Thank you so much for your time today. If you found this breakdown helpful, please like this explainer and add your comments below. If you aren't already, make sure to subscribe to the GAAP Advisors Ind AS Clinic channel. And most importantly, please share this explainer with your contacts, your colleagues, and your audit and finance teams, so we can keep spreading vital knowledge of Indian accounting standards across the industry. Oh, and hey, if you want to go even deeper into the nuances of today's case, make sure to connect with the GAAP Advisors Ind AS Clinic podcast. It's available right now on Spotify, Amazon, or YouTube for a true audio deep dive into the specific issues we just covered. I'll leave you with this final thought to ponder until our next session. If accounting is truly meant to be a universal language, how often does a simple shift in your perspective completely change the translation? Always verify whose shoes you are standing in before you draft your entries. Thanks for joining me, and I'll catch you next time.